Alright, what's going on, guys? Welcome back to my channel. Now in today's video, I'm going to be showing you guys a really cool way on how to fund your investment account without making any more additional deposits. Now this is an absolute great strategy that anybody can use, but especially if you are not able to make weekly or monthly deposits, this is definitely something that you should probably be doing. I try to do monthly deposits and I still do this strategy, and it just helps build that account just a little bit faster. So this is definitely something that's going to take some patience, some time. It's not going to make you rich overnight, that's for sure. But if you're not doing this strategy, you're just missing out on money that you could have had. So what we're going to be talking about in today's videos is covered calls. Now I'm sure if any of you guys watch my channel, you'll know that I love covered calls, and it's one of the main things that I do on this channel. So let's go ahead and let's start out with an example. Let's say you open up a Robinhood account and you start with $3,000. It doesn't have to be that much. It could be more than that. It doesn't really matter. I remember when I started doing this strategy, I literally started out with about $250 and I was able to do that. So any amount of money really works. But you know, sometimes the lesser the value stock, sometimes it moves around a little bit more if it's a penny stock or whatnot. But let's go ahead, let's start with step one. So we're going to use Palantir right here just for an example. So in order to start this process, you have to, number one, own 100 shares of the stock. So it's pretty easy to understand how much you're going to have to pay to own 100 shares. Basically, all you do is you take the price of the stock, add 2 zeros, and move the decimal point 2 times as well. So in this case, it would be $2,675. So that fits in our budget if we had $3,000. Now, it's very important that you do this first step. You have to have 100 shares. It protects you, and it basically is what makes it a covered call. So let's go ahead and let's move over here to trade Palantir options. So you got a couple buttons at the top here. You got buy, sell, call, and put. So we're going to be talking about calls today, but we don't want to buy one. We want to sell because we're selling a covered call. Now there's also the expiration date here. Now some people like selling weekly covered calls. It does seem to generate a little bit more money, but you do get more money up front if you pick a further out date. So for today's example, we're going to pick July 23rd. It's about a month out from today's date. So we got all that figured out: sell, call, and the expiration dates. So for this strategy, you basically want to focus on two numbers: the strike price, and then this is the price that you get paid. So let's say you sell this call right here, which is a $27 strike price, and for selling that covered call, you get $1.25 each share. So what that adds up to be is you do 1.25 times 100, so you would get $125 just for selling this. That money goes straight into your pocket. You could use it to invest in more stocks, you could take it out, but like I said in this video, we're basically going to be using that money to fund more investments in this account. So the reason it gets smaller and smaller is because of the strike price. So let's go ahead, let's explain this as well. So let's say you get in on this stock at $26.75 each share. All right, so we get that. We get 100 shares. We spend $2,675 for the shares. Now, like the other example, we sold the $27 strike price covered call for $125 in premium. Now, what this means, though, is that if this share price gets above $27, you will get the shares that you own called away from you, and you'll have to sell them for $27 a share. So the only risk that you're basically risking here is that the stock might just blow by your 27 strike price, and it might get up to 29, and you'll miss out on some gains. So let's say you don't want to sell one right here. You kind of feel like it's going to move up a little bit more. So you would sell the 28 strike price, and you still get $87 in premium. Now, another thing you got to keep in mind is if these shares get called away from you at $28, then you get the $87 premium plus the stock appreciation from $26.75. So you would get $87 in the premium, plus you would get $125. Now the reason being is because it's at 26.75, it goes up to 28. That's $1.25 each share times 100. So you get $125 plus the $87. So you get a little bit over $200 just for doing this. Now, I hope I explained that well. If I didn't, leave a comment down below. I'm always there to help. I'm always replying to my subscribers, so leave a comment down below. But bottom line, the basics are that you sell a covered call at a designated strike price. You get a premium right away. It goes in your pocket. You could reinvest it in different stocks. You could even put it back into other stock. And then if the share price where you bought it hits your strike price or goes above, then your shares will be taken away, but you'll be able to sell the shares for a profit and you'll still get your premium over here. So that is basically the only downside to this strategy. You might get the shares called away from you and you might miss out on some of the upside. Now, another risk is if the stock falls significantly. But the point of this is to invest in companies that you think are going to grow long term. It can't just be like any random company. I mean, it could. I've gotten lucky on a couple. But you really do want to have something that you feel comfortable holding for the long term and you believe that it's going to keep going up. But like I said, you don't have to have that much. I remember the first stock I ever sold a covered call on was Jaguar Health right here. Now, it was higher when I was selling covered calls. It was about 3 months ago, I think. It was almost it was around $2. But you could literally start with something as small as this. Now, obviously, the premiums aren't as great. I mean, $13 sounds like nothing right here, but for only putting out about $175, that's actually a pretty good return. But like I said, you got to be careful on some of these. Make sure it's something you believe in long term. This was one that I kind of just got lucky on. I was like, hey, you know what? I want to try this covered call thing. And this is basically the stock that got me involved in it. So I hope that all made sense, but we're going to go ahead. Let's go over to my spreadsheet and I'll try to explain it a little bit further. So like I said, for the example, we were doing Palantir. The share price was actually $26.75, I believe. My bad. And for some reason, it won't let me do that. I don't know why. That's kind of weird. I don't know why it's rounding up. But anyways, you guys get the point. Price per share, covered call strike price, we decided we would probably do the 27. You have to have 100 shares, pick an expiration date, and we have one contract. Now from $26.75, if we get assigned on these shares, stock appreciation, we would only get $25, but the premium we collected, if you guys remember, was $1.25 or $125. So you add that up, that would be $150. You take that, you add it to your original investment, and then you could just slowly keep building your way up. So let's say you keep doing this. Let's say you're able to afford 200 shares of Palantir. So you have 2 contracts and you have 200 shares now. So we'll do 200 shares right there. Same expiration date for the contracts. Stock appreciation would double at this point. You would have 50, and then the premium collected would be 250 because you're selling 2 at 125, and then that would add up to 300. So what I'm basically trying to show here is the power of doing this. If you're able to stack up enough stocks, if you're able to put enough money in, you could slowly build this, and $300 is nothing to sneeze at. I mean, that's a pretty good amount of money, especially if you're just starting out investing. I mean, I would take that any day. Go buy some food, gas, pay some bills, whatever you got to do with it, or just keep it in your account. Like I said, just keep investing. So yeah, guys, I hope I explained this pretty well. If you have any questions, leave them in the comments down below. I know I didn't explain it super well, but I think I gave you guys the basics. And if you guys have any other questions, like I said, just leave them below and I'll be happy to answer. So anyways, that is it for today's video. Hope you guys enjoyed it. Leave a like down below. Comment if you have any questions. Subscribe if you're not already to follow more covered call videos and just more stock investing. And with that said, I'll see you guys in my next video. Peace out, guys.